Hi everyone, welcome to another honeystocks.com stock market outlook for the weekend of the 25th of June 2022. Now, before I switch over to my screen share, I just want to once again thank everybody who's reached out over the last few days. It does mean a lot. I put out a piece, a letter on Wednesday, just highlighting the likelihood of a violent stock market rally, and if my newly acquired video editing skills are up to par, there should be something that's popping up here. But I think what I'm being asked at the moment is roughly along the lines of, is this just a textbook bear market rally, or is it something a bit more sustainable and a potential market bottom? So I'll do my best to walk through some of the key charts. I've got a lot of individual stocks that I think warrant being added to your radar. But certainly there's a lot of fear out there. There's a lot of trepidation. I think for many it's really just a case of survival at the moment. But I'm very, very open-minded. I'm flexible, long or short. My time horizon is generally weeks to months. But given the nature of the current environment, it's really a week-to-week thing at the moment. My work does apply to most styles. You'll find that, if you're a swing trader, an investor, trader, my work is probably a fit. I'm personally more of a technical investor. My outlook is a little bit longer term generally. But I also use options as well, especially in the current environment. I think it's very, very important to just define the risk, and that helps me sleep at night. So if you get some value from this, please do hit like and subscribe. It all helps with the YouTube algorithm and helps to get my work noticed and out there a bit more. So it really would be massively, massively appreciated. So let's dive into some charts. Let's see what the market's telling us. Now, I think with the market, the best place to start off is just to spend maybe a couple of minutes just walking through the broader market. My work has had a lot of attention this week. It's been shared with the chart report and the thousands and thousands of subscribers that they have. And really, the thought process is along the lines of, could the 10-year Treasury note yield roll over at these levels? Now, interesting to me today, just that the market has just closed on Friday. The market has done exactly as I expected over the last couple of days. It's had a monster rally to the upside. But interestingly enough, the 10-year Treasury note yield has not rolled over. So at the moment, I'm treating the market currently as a bear market rally. We're seeing that the dollar hold up. I think the dollar has been a massive headwind for stocks, with the dollar holding up on the back of stocks moving higher over the last few days. It leads me to suggest that the rally is going to be a short-term thing. Now, I'm always open to changing my mind on 30 seconds notice, as everybody knows. But that's currently how I'm viewing it. We already know that the yield curve has inverted. So we are predicting and we are expecting a recession, given how reliable the inverted yield curve actually is. But I talked about these charts last week. If you picked up last week's analysis, you'll know that I was highlighting these COVID crash levels as big levels for the Dow. What's happened is not a surprise to me in any way, shape or form. We've had a rebound from logical levels. So although the market, before coming into this week, I think was down for 10 out of the last 11 weeks, it's not any coincidence or any surprise to me that we get a decent green week for the first time in a while. So again, when we look at the Russell 2000, now the Russell 2000 has a history of failed breakouts and failed breakdowns, I should say. So previously highlighted a failed breakout. Now, I actually highlighted this way back in November when all this carnage started. So the question I'm asking now is it doing the same again? Is it putting in a failed breakdown followed by a rip higher? Now, I think we would all be a lot happier if that was the case. We've got the S&P 500. We are still trading below the 10-month moving average, which is a decent risk management tool to use. We've got on the daily chart, it's rebounding from AVWAP levels. Let me just delete that. It's not the moving average there. But yeah, we're kind of in this battleground at the moment with the S&P 500. And of course, I highlighted last week that we could get a bit of a bid in technology. We know that the 200-week simple moving average is very, very reliable, as we can see dating back all the way to 2010. So I think what we've had here really is the triple Qs and the Dow holding key support levels, and we've had a potential failed breakdown in the Russell 2000 small caps. So that is certainly the bullish catalysts in the short term. We've also got the 20-year Treasury bond ETF at TLT. Now, it was flirting with a failed breakdown. Given the inverse relationship, let me just bring over the 10-year Treasury note yield. You might notice that they are inverse to each other. So I'm looking at these two as perhaps a signal. I think if we get the rollover in the 10-year Treasury note yield, that will be a bullish catalyst for stocks. In that environment, you would expect TLT to be moving higher as well. So I'm watching both of these very, very closely. If TLT starts to move higher, again, I'm viewing that as a potential bullish catalyst for stocks. We've had financials, very, very important area of the market, holding on to the financial crisis crash levels, at least in the short term. Of course, I could change my mind by the middle of next week if this chart breaks down. That would be bearish for the market. But at the moment, there are a couple of things that look a little bit constructive if you are looking to take buy positions in the market. For disclosure, in our midweek halftime analysis to our clients and members, we did start to put out some bullish charts in addition to a few bullish charts that were in last week as well. But by and large, we're seeing a lot of the beaten down areas of the market starting to catch a bid. So this is what typically happens in bear markets and why bear markets are notoriously difficult. You find that the crappiest stocks with the worst technicals, the worst fundamentals that have declined 50, 60, 70%, they will now start to rip 20, 30, 40% on absolutely nothing. And that is why it's difficult, and why my message to clients and members is you cannot really be aggressively long or short. If you're a long-term investor, I get it. You're always looking at dollar cost averaging, buy positions, that's great. But if you are on the fence and you're looking to maybe time the market a little bit better than that, then it's very difficult to be aggressively long or short. And certainly something that I'm advocating quite a lot at the moment is using risk-defined options, because the last thing you want is to be caught in a short position and you get that dreaded 20% gap up and it just starts flying. So that's really how I'm viewing the broader market at the moment. Now, I had a lot of messages via social media because of the chart that I put out for China this week. Now, something that's very, very interesting to me is nobody's really talking about the relative performance of China year to date. Now, when you drill this down and you look at the last 3 months, China is actually positive over the last 3 months, where the US markets have been absolutely decimated. China is holding up very, very well. And when you look at the China performance, and we're looking at the Hang Seng and the the Shanghai Composite, we can see that they're only down 6 and 7% for the year, whereas the triple Qs, the small caps, and of course the S&P 500 have been killed. So China is now starting to look a little bit more interesting. Yes, there's a lot of volatility attached to it. There's a lot of headline risk. But what we are finding now with the headline risk is the dips are being bought. Now, who's buying the dips? That's obviously the big money at play. But for me, looking at the Hang Seng Index in particular, it's actually rebounded from very logical levels dating back all the way to 2012. Now, of course, like I said a second ago, you have a lot of volatility to endure if you are looking to invest in Chinese equities, but the charts would support perhaps testing the water a little bit. I wouldn't go crazy personally, but if you are someone who likes the Alibabas of the world, the JD.coms and all the rest of them, then there is some constructive charts out there. Now, I do have some individual charts that I want to provide updates on. I put out many of these charts last week. Now, Microsoft, as we know, has rebounded from logical levels. There is zero surprise here for me. This was a chart that was put out to our clients and members a few weeks ago, and the support levels have held up very, very well. For those of you that follow my YouTube channel, you'll know that last week I put out a video on Amazon and just highlighting that this was a big level for Amazon. Now, yes, it's got negative earnings growth. Yes, it's got reasonably high PE ratio, but the $100 level is currently held. It's moved 15-16% already. I was actually expecting the stock to break down, if I'm being completely candid with everybody, but ultimately it has rebounded in a meaningful way. We've got Nvidia, which is currently holding on to what I believe to be a key level, the $150 level. We've got potential failed breakdown in AMD. Now, I talked about this chart last week. I have also shared it with our clients and members over the last week or so as well. And potentially, if you are in the camp that AMD is due for some kind of reversal, whether that be short term, long term, this is what I would deem to be what's called an optimal entry. That would be an entry zone, and there's an upside objective there to be had. I'm looking at that trend line as a potential target level. I do expect volatility to kick in again with the market soon. For those of you that like to perhaps pay attention to the VIX, for example, you'll probably notice that the VIX is in a bit of a range, and certainly when it gets to the lower end of that range, the volatility just kicks in. So it's something to be aware of. So that would support, when we have that sideways chop, that supports more of a swing trading style, which is kind of what AMD chart is kind of telling us at the moment. We've got ExxonMobil. Lots of questions on energy this week, because I put out in our letter on the 8th of June just calling for a pause in energy. Now, of course, that has played out, but XOM was a big component of that. And certainly when you look at XLE, etc., a lot of those names have just fallen off a cliff. I'm sure energy will be fine. A lot of the stocks have low PE ratios and of course incredible earnings growth. But I think the bigger story is probably what's going to happen with crude oil and Brent oil, and certainly the prices there. So something to keep an eye on. PayPal holding on to key levels. Again, declining 50-day simple moving average. I think for me, we do have a bullish divergence. It probably becomes more appealing if you can get a confirmed breakout above the 50-day simple moving average, which over the last 12 months has been a bit of a problem for that particular stock. We've had a breakdown in Micron Technology. I think decent fundamentals. Lots of stocks this week have put in failed breakdowns and are rip higher. It's a little bit concerning that Micron hasn't done that. It still remained in a bearish environment for me, but certainly we'll see how that begins to look next week. I think if Micron can get above that $6 to $8 level, then it probably becomes more appealing. But at the moment, it's probably considered, for my work, certainly a bearish chart. Block Inc., another big one. I get a lot of messages on, I guess, the same stocks. With something like, Block, or I still know it as Square, I don't know about anybody else, but it's obviously got a huge PE ratio. We've got negative 12 months earnings growth. We've got Bitcoin on the balance sheet. Now, Bitcoin is, of course, rebounding meaningfully over the last week or so. Is that going to continue? I don't know. I do have doubts about that. I do have an Ethereum position that I will go over the chart on that in a second, but I think with something like Block, the 20-day simple moving average and a declining trailing stop loss. Now, I've got very specific parameters in place for this. It's a very individual thing that I've looked at. So I think that this is probably quite a key level. I think I would have more confidence in buying Square if it can, move above the 20-day simple moving average, for example. But it is still a bearish chart, and until price proves me otherwise. Again, I got a lot of heat on this when I posted this tweet last month, 6 weeks ago, but certainly it is still a bearish chart at the moment for me. Likewise with SoFi, declining 50-day simple moving average. Will it rally in and fail again? I don't have the answer to that. It is possible that it is also putting in a higher low, which is a characteristic of a potential uptrend. So I am going to be watching SoFi very, very closely. Highly speculative growth theme, I know, but if it can get clear of that 50-day simple moving average, which dating back to its IPO has been a big problem, so certainly that's something I would have a look at. ARC, I covered this one last week. It's already approaching the target. This is actually one of the charts from our members sector chart book. All of our clients and members have access every single day to all the ETFs and the sectors that I cover. There's around 50 individual sectors and ETFs that I keep a close eye on. We've got Nike holding on to support levels. Again, I think if you are in the camp that inflation has peaked, which I am potentially starting to arrive at that conclusion, maybe stocks that are in the apparel, consumer discretionary, maybe start to become a little bit more appealing for potential mean reversions. Of course, all bets are off if you start to move below COVID crash levels. I think that's a big problem. Netflix covered this one last week, already approaching a potential target. I think if it can get above 208, then that might be a potential entry for new investors. XME, again, another one from our sector chart book, declined hard on this breakdown, and it has rallied a little bit. We'll need to see how things play out with XME. Obviously, big metals, mining, etc. have been massive over the last 6 months. They've started to decline hard with the rest of the market, so it'll be interesting to see if it can reclaim what I deem to be a significant level. Again, I made a bearish call on commodities this week. A lot of the commodities are starting to decline hard, which is one of the components of the thought process where inflation is probably the point I'm trying to make here. With the declines in the commodity space, how will that impact inflation? And I think if commodities are starting to decline, lower gas prices, etc., that could be a bearish catalyst, of course, for things like the commodity index. Wanted to touch on Ethereum because, again, I got a lot of attention last week on the chart that I put out for Ethereum. Now, we all know that cryptocurrencies it's probably sentiment is as bad as it gets. I'm seeing a lot of the crypto maxis that are quite prominent on Twitter and YouTube, etc., getting killed. I guess the comments are pretty disgusting, but I think with Ethereum, sentiment's low now. When we get to really extreme oversold conditions, I like to start to look at things historically and how things have performed. Now, when Ethereum gets into oversold conditions, which it was last weekend, we can see that there's been 3 previous occasions, and 2 of those occasions generated 100% plus rallies, whilst we had a mini 28% rally. Now, currently, the chart that I posted to social media was at around $950. It's obviously doing very, very well, so it is in this range at the moment. But I think key to this chart is going to be, can it get back up above that $1,400 level? If it can, it becomes easy to manage risk. You can just move your stop loss up to just below 1400, and then hope for that failed breakdown rip higher event. So a lot of that will depend on what happens, I think, with Bitcoin. Now, a couple of charts that were shared with our clients in our midweek halftime analysis during the week. One of them was for Chipotle, just basically saying that if the market decides to put in an oversold bounce, which is possible, this could be appealing from a buy perspective, purely for no other reason that you're able to manage risk. I like to buy stocks when they are at the bottom end of a range, and you can just place your stop loss in here. You don't need to take any chances. If you take a buy position and it declines, no problem. You can get out with minimal damage. You don't need to sit around and wait for this to hit $500. So from a risk to reward perspective, it's obviously played out pretty well. Exactly the same for CPRT as well. Again, these are the types of charts that are useful at the moment. Big rebounds over the last few days in stocks like CPRT. And the other thing to say is that you do, I think, in my opinion, have to be looking at stocks that have decent earnings growth and reasonable PE ratios. There's nothing, there's no secret science or anything to it. I think with fundamental data, you could get into the weeds and start to overanalyze things. But for me, it just comes down to, at the moment, earnings growth, PE ratios, what does that look like? And then you can start to kind of formulate a plan and work with the individual charts in question. So hopefully you've got something from that. If you are somebody that struggles with the market a little bit, feel free to stick around for a second, but don't forget to hit the like, subscribe, and let me know in the comments, what charts are on your radar, and what stocks do you think we're in a bullish environment? Are we in a bearish environment? Let me know in the comments. But if you have just stumbled across my work for the first time, feel free to go and check out our website, honeystocks.com. We provide technical charting research. Every single week we provide our premium weekend analysis to our clients and members every single Saturday. Provide actionable trade ideas. We provide our midweek halftime analysis. I provide access to a wonderful trading community. I provide charting support on a daily basis. I'll show you what that looks like. And also, if you are somebody that's looking to learn how to build a process and stop acting on feelings, then we do have access and provide full access to our technical analysis program, which I used to charge a lot of money for, but now I just include it as part of all of our memberships, which also comes with, I should add, a 7-day risk-free trial. But I do know that with the market, it's very much a case of what have you done for me lately. I think you just need to go and have a look at some of our recent letters to the subscribers. There's over 1,000 investors that subscribe to my free email every week. That was the headline on Wednesday evening. Go back to the 8th of June, calling for a pause in energy. But we could go all the way back to where it all started, back in November, highlighting the failed breakout in the Russell 2000. We could go back to the start of the year, exactly the same chart for the S&P 500. And just to give you a pro tip, that it generally starts with failed breakouts. With failed moves, we get fast moves going in the opposite direction. And I like to keep an eye on a lot of the major averages. Start of the year was calling for a valuation reset. And if you want to go all the way back to 2020, front and centre on my website is how I predicted the crash of 2020. The analysis that was provided to our clients and members a week before the crash has been uploaded, and I think there's a lot of learning for those that are, perhaps want to get a little bit more insight into how to read the broader market if you are on that path. But just to show you what our trade ideas look like, this is Zillow, recent alert that went out. We've got Cloudflare, massive winner. Square Inc was a massive winner. Box, another massive winner. This is one of our recent shorts. It met our downside objective around 21, 22. Antero Resources has been absolutely massive over the last couple of years. But I'm very, very unique in what I do. For those of you that follow the channel and follow my work across social media, you'll know that I log every single one of our high conviction ideas. I've done this from day one. I don't know anybody else that does this. In fact, actually, I do know one person that does. I've got a lot of respect for the work, but certainly feel free to go and scrutinise that. Really just shows you that the types of charts in the stocks that I like to recommend. There's no penny stocks, there's not any pump and dumps, or quality stocks, quality names, long or short, depends. It's predominantly long only, but when the market does come under pressure, I think shorts, of course, and puts make a lot of sense. So feel free to go and check that out. But I think if you are someone who has a mid-term approach, maybe you look at a few weeks out, a few months out, maybe you're looking to get away from day trading because you just can't get the consistency like 99.9% of day traders. Maybe you want to learn technical analysis, or maybe you just want to be part of a community. There's a lot of reasons, I guess. I think, if you're work, family, business, and you don't have the time anymore, maybe you're just sick of hunting around social media every week. Probably my work's a good fit, but feel free to go onto our website and check out our testimonials. Some massive performances over the last few years. Investors telling me they want to be a member for life, and I can't say it any more than what my members do. So feel free to go and check out our website. But if you've stuck around to the end here, thank you very much for watching, and perhaps I'll welcome you soon. Enjoy your weekend.